Thanks for starting your week with us. Hello and welcome to Business Daily. I'm Lee-Ji-yoon in Seoul. We have a lot on our plate today, so let's get started by taking a look at today's highlights. Korea's industrial output posted a surprise fall last month, mainly due to a slowing demand for cars and chemicals. Are you debating on which insurance to sign up for? Worry no more. Korea has launched a so-called online insurance supermarket for people to look up and search for plans that best fit their needs. Korea's overall industrial output dropped by the biggest margin in 9 months in October. And the Korean government is linking this with sluggish exports, which are also hurting manufacturers' sentiment. Our Hwang Ji-hye has more.
Statistics Korea says output across all industries was down 1.3% in October from a month earlier. That marks the first drop in 5 months and the biggest decline since January this year, when the figure dropped 1.9%. The agency attributed the slump to a drop in production in the mining and manufacturing sectors that were hit hard by slumping outbound shipments. Exports have dropped every month this year, and in October, they plunged nearly 16%, posting the biggest decline since the height of the global financial crisis some 6 years ago. Such gloomy data is directly reflected in how businesses are seeing economic conditions. The Bank of Korea says its manufacturers' business sentiment index for November came in at 68, down 3 points from a month earlier. A reading under 100 means pessimists outnumber optimists. But every cloud has a silver lining. On the back of government-led measures to boost domestic demand, retail sales rose 3.1% in October from the previous month, the biggest rise in nearly 5 years. The boosted spending also pushed up output in the service sector by 0.2%. While the finance ministry cites the slowing Chinese economy and the recent terror attacks in Paris as lingering uncertainties for the local economy, it expects the recovery momentum in spending to continue for the time being. The Korean economy grew 2.4% in the first 3 quarters of this year from a year earlier, higher than the OECD average of 2.1%. Hwang Ji-hye, Business Daily.
Now, it turns out that the Korean economy fared relatively well in the third quarter when it came to staying on track for growth compared to many other major economies. According to OECD data, Korea's GDP grew 1.2% on quarter in the July to September period. This was a strong rebound from the second quarter when the Korean economy expanded a mere 0.3% on quarter. This is also the first time it recorded above 1% expansion in 6 consecutive quarters. Meanwhile, economic growth slowed in many OECD countries. The Eurozone saw growth sliding by 0.1 of a percentage point to 0.3%, while in the U.S., expansion decelerated to 2.1% on an annualized basis compared to 3.9% in the second quarter. And for more on last week and this week's stock market action, we have economics reporter Choi Jin-seok from SBS CNBC joining us on the phone today. Hello there, Jin-seok.
Thanks for having me, June.
All right, let's get started by looking at how the Korean stock market closed last week.
Yeah, both the Kospi and Kosdaq finished mostly flat last Friday. The Kospi fell by 0.08% to close at 2028, while the Kosdaq gained 0.11%, closing at 694. The market lacked a major catalyst to move the indices in either direction, as the U.S. stock market closed on Thursday due to Thanksgiving, and other market events, including a potential December rate hike by the Federal Reserve or the Fed, have already been largely priced in. For the week, however, the Korean equity market continued to enjoy strong gains. The Kospi rose by about 2%, surpassing 2,000 on a weekly basis for the first time in 2 weeks. The European Central Bank, or the ECB, is widely expected to announce additional asset purchase programs or quantitative easing, or QE, at its December monetary policy meeting this Thursday local time. Expectations for a further injection of liquidity boosted the sentiment throughout global equity markets last week.
Then how did the Korean stock market close on the first day of this week?
Both indices closed weak as China's stock market experienced a heavy sell-off last Friday. Chinese bourses sent shockwaves across global markets once again, logging over a 5% plunge on Friday. It was the biggest one-day fall in 3 months. Chinese authorities' investigations into 6 major stock brokerages over suspected violations drove shares in Shanghai sharply down. The Shanghai Composite Index has been down as much as 6.1% within the final 15 minutes of trade, which means the Korean stock market didn't fully price in a sudden sell-off in the Chinese equity market on the Friday session. This is why the Korean stock market received a bigger hit today.
All right, now, those who remember last summer's or past summer's Chinese stock market rout will definitely want to take a closer look at this as well this week.
That's right. Along with investigations into the country's major brokerage firms, Friday's drop was partly due to new share issuances this week. The China Securities Regulatory Commission, or CSRC, said earlier this month that it would allow new initial public offerings or IPOs to resume following a suspension during the market tumble in July. New share sales traditionally hit sentiment as investors worry that the offerings will divert demand from existing shares. That's what prompted fears that the country's stock market could go through another sharp correction after Friday's sell-off. If you remember, the Shanghai Composite once fell as much as 45% after hitting a peak in June just within 2.5 months. Fortunately, experts say there's a high possibility that the Chinese stock market will be stabilized soon because warning signs such as high stock valuations or excessive margin trading, which means investors borrow money to buy stocks, do not seem to be appearing this time. But we still need to take a closer look at the market this week too.
And the ECB policy meeting on Thursday seems to be another major market event this week.
That's right. Expectations for further stimulus seem to be higher than ever. Some experts and investors are as convinced this will be the case as they expect the Fed's December interest rate hike will take place. A Reuters report last week indicated that ECB policymakers were looking at widening the scope of their bond buying or implementing a penalty charge on banks that leave cash with the central bank. We can expect 2 possible scenarios. First, the ECB may increase the amount of its government bond purchase. Currently, they inject 60 billion euros by purchasing bonds. Or they could extend the duration of its QE from next September to 2017. Second, the ECB could lower its already minus deposit rate. The ECB's deposit rate is minus 0.2%, which means European banks will, in its essence, be paying a 0.2% penalty if they want to leave cash with the central bank. Minus deposit rates in that sense are considered to be another stimulus measure to boost lending to the private sector. Both scenarios can work positively for global financial markets. Therefore, I would say we need to see which direction the ECB decides to go in this Thursday. This has been Choi Jin-seok from SBS CNBC.
Signing up for insurance can often be daunting. Out of the hundreds of insurance plans out there, how do you know you're getting the best fit for the best price? Well, a new platform that'll help you do just that is only a mouse click away. Our Eunice Kim has the details.
It's called 보험다모아, or Gather All Insurance, a so-called online supermarket where subscribers can search, compare, and sign up for the plan of their choice. Financial Services Commission Chairman Im Jong-yong himself was at the demo presentation. Fill in data such as age, gender, length of desired plan, and a list of plans that pertain to the would-be subscriber pulls up by price. From the more simply structured indemnity insurance to auto, travel, and endowment, 207 plans from 36 insurance companies have been registered so far. The platform launches on November 30th, 6 months after Korea's top financial regulator formed a task force for this foray into fintech. Utilizing cyberspace to equip customers with data to make an informed choice, and also to fuel more competition into the insurance industry.
With the heightened competition, we look forward to yielding more self-driven creativity and reasonable prices.
The industry anticipates the fiercest battleground will be in car insurance, as it's the required form of coverage that must be renewed every year. This was seen in the UK, which launched a similar bid in 2003. More than 30% of people with auto insurance purchased their policy online in 2013.
When we get to a point where all insurance policies can be compared online, companies will inevitably have to offer competitive prices.
Many eyes will watch how this tech injection will impact the choices consumers make and the dynamics of the insurance industry. Eunice Kim, Business Daily.
Foreign investment banks forecast that Korea's real estate market will slow in a couple of years amid worries of an oversupply of new homes. According to Korea's Center for International Finance, many of the banks expect the domestic housing market to reach its peak next year. From 2017, however, an increased supply of homes and stricter loan regulations are expected to lead to a market slowdown. Switzerland-based Credit Suisse forecasts that the rise in Korea's housing prices will lose steam by then, as it is the scheduled move-in year for many new apartments. U.S.-based JP Morgan added that market sustainability will largely depend on whether the increase in household income can fuel continued demand. Starting next year, Korean banks are planning to apply stricter rules on future housing loans. As the country strives for a more sustainable energy future, Korea has been promoting smarter use of energy, as it relies a lot on nuclear power that generates less greenhouse gases. But some experts say now is the time for Korea to shift its focus to other forms of renewable power. Our Son Jung-in has this report.
According to the U.S. Central Intelligence Agency's World Factbook, South Korea is the world's 11th largest electricity producer, generating some 517 terawatts a year. It's also the 10th largest energy-consuming nation, using more than 480 terawatts every year. Considering Korea is the world's 13th largest economy, its energy production and consumption seem to be on par with its GDP. The figures also reveal Korea is highly dependent on nuclear power for its energy needs. Korea ranked 4th in the world for producing electricity from nuclear fuels, accounting for 27% of its total electricity power output. France was the most dependent on nuclear energy at nearly 50%, followed by Armenia and Belgium. However, Korea's electricity production from other renewable sources such as hydroelectric, geothermal, and wind plants accounted for a mere 2%, placing Korea 82nd. As the world's major nations are leading the way toward a cleaner Earth by investing in renewable energy sources, Korea seemed to be lagging behind. Environmental experts note that Korea's energy consumption is among the highest despite its relatively small size and population. They say Korea has to come up with a strategy to share the production of energy using other eco-friendly options. Son Jung-in, Business Daily.
And that wraps it up for today. But we'll be back tomorrow with more business news that matters to you. So don't forget to tune in then. Thanks for watching, and bye-bye for now.